the hot seat this evening, Henry van Deventer. He's a financial planning coach at Axis, and we're discussing financial planning going into 2012. We've got to throw back to the uncertain environment globally, how that's impacting sentiment when it comes to South African investors. Are you fielding calls on a daily basis from clients that are panicking and say, what is going on out there?
But funny enough, it depends on education, you know, and I think we were talking about financial advisors and what they miss and what they do pick up on earlier on. And especially when investors don't know what to expect. It is very difficult for them to remain invested in such an incredibly uncertain environment as we're currently finding ourselves in. And the problem is, you know, if investors don't know what to expect over the next year, they tend to make emotional decisions now that impacts very severely on them over time, and they only appreciate that once it's too late.
Talking about emotion, how emotional are you at the moment? Well, you've got to make calls, and on a day-to-day basis, you've got to live or die by those calls.
100%. I mean, Bronwyn, if you look at our market over, let's call it the last 12 months or so. In fact, I remember 2 years ago, you know, someone was out here with the CFA Institute, and they said, you know, it's going to be a range-bound market. Now, investing in a range-bound market is very different to investing in a trending type of market. And we've almost ended up in a sphere right now where it's almost a trader's market, and provided you can call the market correctly, which is impossible, it's very difficult to make money by staying, for example, long buy and hold type strategies in equity, for example, over the last 12 months. So what's your view on that?
Well, the interesting thing is, in picking up on that sentiment, what we've been looking at recently is the South African Volatility Index, the SAVI, which in itself is it's kind of a weird and a bizarre index to look at, because it doesn't tell you where the market's going to move, but what it does tell you is, well, they call it the fear gauge. You know, how uncertain or
it's
how
like the
fearful.
VIX in the
yeah.
US.
It's a VIX in the US. It's
the fear factor gauge.
Yeah, VIX there, SAVI over here. For us, it's fairly recent. You know, I think it was probably introduced at the worst possible time, 07. You know, so we saw 08, 09.
Dramatic swings up and down, volatility up and down through the roof.
Absolutely. And I mean, to give you an indication, you know, a positive market, you know, we'll see a volatility index at a level of, you know, under the 20s, high teens. What we've seen on average over the last 3 years, a level of, you know, just shy of 28%. It peaked at like 52 in sort of, you know, 2009. But what that does tell us is, although there's not a lot of optimism in terms of where the market will be moving over the next year, the pessimism to a large extent has abated. But right now, we're just left with complete uncertainty. Not even the institutional investors know where this thing is going to go short term.
So what do we do in terms of asset allocation? You've got your bonds, you've got your property, you've got cash, you've got equities, you've got inflation-linked bonds if you want to drill further into the bond spectrum. What are you advocating? And obviously I know this is a difficult question because it depends on the risk profile of the client ultimately, and you've got to sit down and do that analysis with each individual client. But can you put out a general rule of thumb right now?
I can, but I'm going to start sort of at your last point, the risk profile of the client and what that means and implies. You know, the problem is, and I don't know if you guys have done risk profile analyses in the last while. Firstly, I'm not sure how scientific they are. You know, in the second place, you know, I can come out as aggressive, and you guys can as well, but for us that would mean fundamentally different things. So instead of looking at risk profile, what investors should look at is, what should I expect in terms of investment behavior, especially over the short term? Because that's what drives our investment decisions so much more. In short, you know, what we've seen in the South African sort of ALLSI over the last 10 years is a level of volatility of about 18.5% odd. You know, gave you an average return of about 17.7 or so. So, you know, you do get rewarded for taking extra risk. If, however, you asset allocated, you're in a balanced fund, you know, sort of 30% bonds, 10% cash, 60% equities, instead of getting a 17% return, you would have had a 15.5% return. But your levels of volatility would have fallen to about 11.7. So in short, what that means is just by asset allocating and not betting all of your money on one asset class, provided that you're comfortable with earning 1 or 2% less, you can wipe out a third of your short-term volatility. And if that's going to keep you invested, then that is the consideration that should drive us when we put our money in our savings in the first place.
100%. I mean, something I want to latch on to, because I was looking at this, looking at some numbers on this, and if you use your kind of rule of thumb balanced allocation across multiple asset classes, that works well over a long period of time as well. You look at recessionary time periods as well. You've got that diversification benefit that certainly comes through. But when you look at financial crises, for example, so if you look at time periods, late 80s, you look at time periods 2008, just as an example, what tends to happen is when you have a collapse there, all of your correlations tend to 1. And as a result, you see a mass sell-off across equities, bonds, cash is always cash. How do you look at addressing that over an investor's time period? I mean, let's assume investors' entry point isn't necessarily defined. How does that reconcile with correlations that 10 to 1 in a crisis scenario?
Well, if I'm going to jump off a building, the first question I'm going to ask is how high is the building? You know, so if I'm going to apply that to asset classes, at times of uncertainty and volatility, yeah, sure, there's a close correlation between different asset classes. However, you know, the downside potential in some, you know, are not nearly as significant in the downside potential of others, which makes an active asset allocation strategy so hugely important if I want to effectively manage risk over time. So, you know, what I must understand in the first place is, yes, I can lose money, but by being intelligent about my asset allocation, I can significantly limit how much I'm going to lose at times of uncertainty.
So what are you advocating in terms of asset allocation right now to limit potential risk for investors?
Well, Bronwyn, you catch me out on this one. I would always encourage any investor to go for as much equity exposure as they can, especially now. You know, there's a big difference between the 1-year story and the 5-year story if you look at local and global equity markets. What I would advocate right now, you know, if we look at the current interest rate environment, inflation rate environment, you mentioned inflation-linked bonds just now. You know, our yield going forward for the next year or two would certainly put inflation-linked bonds ahead of, you know, your conventional bonds. You know, cash is dead. You know, if we look at global bonds, pretty much not a great place to be. But
so you're very positive on equities as a basket?
Very much so, locally and globally. You know, if you start looking at earnings coming through locally and abroad, especially taking into account the forward PEs, you know, which are very much earnings driven. You know, I want to buy something cheap and sell it expensive, and if it means I have to wait a year or two, boy, you know, I'm in.
As an equity man, this must be music to your ears?
Actually not. I mean, given our outlook right now, we're pretty bearish, especially over the shorter time period. I mean, something important that you need to latch onto here is that when you're looking at asset allocation, you've got a targeted sort of return in mind, and inflation-linked bonds, which is something you've mentioned, features very highly in some of the beta portfolios that we run. So to give you that kind of underpin to make sure that you don't necessarily run this huge risk of not meeting your benchmark, I think that's a critical component of any kind of asset allocation strategy I look at. Have
inflation-linked bonds become very popular of late, because more and more fund managers are speaking about them? John Oliphant, I keep mentioning Government Employees Pension Fund, the biggest holder of inflation-linked bonds in the country. Obviously, they have 940 billion rand in assets under management, so not difficult to take that position. Yeah. But certainly, have they become more topical?
I mean, inflation-linked bonds right now, you know, especially given the outlook we're seeing right now, very, very much in demand. I think there's almost a chronic shortage of supply, and in some instances that results in those assets being priced very aggressively because there's so much of demand behind that. So yeah, absolutely something that's quite topical right now based on what people's outlook is for inflation going forward.
There's one final consideration I want to throw into the pot though. If you're going to asset allocate today based on an optimal 1-year return versus an optimal 10-year return, your asset allocation would look fundamentally different. You know, if I'm going to take a short-term view, I can certainly understand more bearishness towards equity. But the bottom line is, you know, if history is any indication, if I'm going to be invested for at least the next 5 years, my odds of losing money in a more aggressive strategy, certainly if history is an indication, are minimal. You know, so I have to understand, before I'm going to asset allocate my money today, when am I going to need the money and what am I investing it for? And if I'm 45 years old and I'm only going to retire in 10 years' time, you know, or buy that Lamborghini at age 65, as many people in Sandton seem to be doing nowadays, then being bullish on equities actually makes a lot of sense.
How are you dealing with the news flow, coming back to this 2012 scenario? And obviously part of what you said earlier is the education drive. Your investors need to understand you've got to ignore the short-term noise, you're in for the long haul. But the investment landscape, people say, could potentially have changed dramatically, perhaps even forever. Developed world versus emerging markets, etc., etc. It doesn't appear as though an end-of-the-world scenario is going to unfold out of the Eurozone, but we raised the US as a potential risk down the line. At the moment, we've just parked the US and said, well, they're paying off debt with debt, so that's all hunky-dory. But the investment landscape longer term could be a completely different picture.
Well, I mean, it depends on where you see. Well, firstly, it depends on your view on global economic growth through the course of the first 10 years. Where is it going to come from? And will the corporates, you know, survive the governments? You know, you guys spoke about the states earlier on, and yes, you know, debt is an issue, and the impact of that in the national economy is an issue. But at the same time, we're starting to see, you know, consumer numbers and retail numbers, etc., starting to tick up for us. You know, so people are starting.
So there is traction in the US economy. I do definitely get that.
There is absolutely traction in the US economy as things stand right now. You know, the other thing that we must not forget is that things aren't always as bleak as they seem. I mean, if you look at private and public sector debt in the US as a percentage of GDP, we're looking at about, you know, 300%, 289%. UK is on a 497%. And there are a bunch of countries in between the US and the UK. So what that means is, it is much more likely that debt will eat other developed economies before it eats the States. However, the States has got a huge consumer sector driving economic turnaround, and we've already started seeing the signals of that. We've already started seeing unemployment numbers, to drop down on us for the first time in a while. I don't think it's as doom and gloomish as some of us may believe.
That was particularly to you. Did you see?
I could have a very long conversation with you. I'll give you a shout.